Hello everyone, my name is Arif Aikal bin Abdul Hakim. So today I will answer to the question, which is how does Diamond Chemicals evaluate its capital expenditure proposals and why such a complicated scheme? So to answer this question, this question is based on the case study that we read. So Diamond Chemicals has introduced a variety of measures to displace its capital budgeting, such as earning per share, payback period and internal return rate. So, however, the NPV and internal return rate are the two most useful tools. The function of NPV is to evaluate the project since it has a lot of costs and to check all of the project income. Additionally, IRR should be included since if you want to use the NPV, IRR should be used as well. However, there are challenges when using these methods. For example, if the project cash flow is negative, so in this case, the EPS method is suitable for checking projects in the short term because it focuses on the current cash flow. So that's all from me. Thank you.
Hi, my name is Nur Aslim Balkis binti Rohaizal and my metric number is BB211611151. So this is my question and answer. What is the Transport Division suggestion? Does it have any merit? The Transport Division advised the tank car acquisition be included in the initial outlays because growing output will deplete the capacity of the current tank cars, forcing the business to purchase them in 2010 rather than 2012. This time change will alter the timing of cash flow and have a direct impact on the rise in depreciation. Greystock, on the other hand, claims that it should not be included because it originally uses the Transport Division's spare capacity. The Merseyside project must also include the acquisition and amortization of new tanker vehicles. The revised financial analysis uses the higher depreciation of the newly purchased vehicle as a result of the project to compute the true cost of the Victoria Chemicals investment.
Assalamualaikum, my name is Izzat Razik bin Muhammad Rizam, and for my question is, what is Director of Sales suggestion? Does it have any merit? Firstly, the sales director contend that the economic slowdown in the sector disappearances will lead to an oversupply of production, forcing management to reallocate capacity, which will enhance demand once the market recovers. The cost of buying and selling a certain item are combined to form the cost of sale. If the sale exceeds the cost of capital, the gross profit or gross sales of the assets is computed, and if not, the cost of capital is the gross profit or net profit. And lastly, they suggested a 9 million initiative to upgrade, streamline and boost the productivity of the production line. Thank you.
Hi, my name is Hana Maisara binti Hisham and metric number BB211611186. Today, I want to present why did the Assistant Plan Manager offer his suggested change. First, Assistant Plan Manager Morris has proposed the refurbishment of a spread section of the Merseyside plant that produces ethylene propylene colopolymer rubber (EPC). Next, this advantage would still result in a negative NPV and loss of £750,000. Morris claimed that the encouraged NPV of multiplier restoration can tolerate the negative NPV of EPC project. Lastly, another important issue would be not sharing all critical information of investors but hiding this from them. Tweet is acting in self-interest for taking this project rather than thinking and looking out for company, and it is obviously reject this proposal. Thank you.
Assalamualaikum, my name is Akid Darwish. So today I will talk about the question number 5. So the question is, what did the analysis from the treasury staff mean by his comment about inflation? Do you agree about it? So my answer is, throughout the NPV calculation process, the cash flow are discounted based on the rate of return. The firm simply utilizes nominal rate of return and does not account for inflation, which worry for the treasury team. The treasury staff is accurate in this regard. The cash flow and the rate of return used in the NPV calculation should be able to account for inflation. The rate of return and the cash flow should both be either nominal or real. The same cash flow are considered at several points throughout the project. The cash flow are not adjusted for inflation, thus the rate of return should be 7% or real. So that's all from me, thank you.
Hello, my name is Awamil Al-Faris bin Sufyan, and now I will answer the question number 6, which is how should Greystock modify his DCF analysis? Okay, however, after studying Greystock investigation, Andrew Gowan of the Treasury staff offer a few suggestions which rate should be used. He stated the money flows and discount rates should be consistent in their assumption about growth, which is correct. And inflation rates are verifiably about 2 to 3%. However, Greystock did not consider this in his investigation. This would imply the organization's true target is 7%. To keep the inquiry as predictable as possible, we set a 3% growing rate and assume. Okay, so for the question number 7, it's me again. So the question is, what is the Merseyside project worth to Diamond Chemical? So the value of a project to a company is determined by how much profit the project can generate for the company, like the Merseyside project for Diamond Chemical. So the discounted cash flow, which is DCF, calculation method used to measure the efficiency of this project. So this method is based on projected future cash flow, which are then adjusted to determine the current market value of the company. So a company's financial future can be seen by performing accurate calculation. It is usually taken into account for the next 5 years in order to see a positive rate for the company's profit. So that's all from our group. I hope this answer will make some answer to this question. Thank you.